Rao, good morning. Can you hear me, sir?
Yes, I can.
Do you think Fed has played it very cleverly? All they've done is they've bought time. That's it.
Yes, exactly. And he said that pretty much very clearly that at this point, the data is kind of balanced. There's not enough data to support a rate cut at any point. Raising rates is out of question. So that was a good thing. That was a dovish thing. But cutting rates, I think he said essentially maybe one, he implied, maybe two if things get really, uh, things cool down. But at this point, the data is too hot for him to really think about cutting anything. So I think he played it safe. He kept options for himself. He didn't lock himself in a corner like he did in the past, saying three cuts and all that. No more. He said, you know what, it's open. I want to wait and see. I don't know where it's going yet. I cannot promise you anything. This is what it is. The data is still strong. Economy is still strong.
Now, Santosh,
So
there are two camps in the market. Camp number one, that Fed is unlikely to cut rates, and that's camp number one. Camp number two is that if the rate cut does not come in, that means that in the near term, that's more bad news than good news. Why? Because that is something financial markets had factored in, or were factoring in, or were hoping for when 2024 started. So, do you think, while there is no rate hike, but the fact that there is no mention of a rate cut, that actually is long-term negative?
No, I don't think so. I think the market will adjust to that. I think the biggest problem was the expectations was not meeting. They were not in sync, the reality and expectations. So I think what will happen is the market will adjust to this data. And we saw initially how the market reacted. We thought he was less hawkish, which essentially means he was dovish. So I think the market reacted very well, but then they realized that, hey, it's off. Let's not get too ahead of itself. So I think it needs to digest this whole thing. I don't think it's a negative. It needs to stay there. The only place where interest rates are going to matter is in terms of the interest payments on the federal deficit, and that's piling up. And I was reading one data where for this first time, the payment on the debt is going to be higher than the defense spending as such. So the payment for defense. So I think that's a negative there. So it's going to hit us on that side. But in terms of the company's fundamentals, most of the people have termed out their debt. So they've refinanced. The companies are operating very well. And you're seeing that in the earnings reports. Every company was beating on the bottom line and maybe slowing down on the top line, which means that the margins are good. Operational efficiency is very much there. Cost cutting is there. So companies are pretty much ready in this setup. So what we don't want is things to go very bad, where he has to cut two, three times, even when the employment data is still good, which means something else is going on. We don't want that. At this point, hey, steady as she goes. Things are fine. No need to cut the rates yet or raise the rates yet. Leave it as it is. It's fairly balanced, like he said, in terms of risk and reward.
Okay, fair enough. And what about the outlook then, Santosh, when it comes to the stagflation? Do you think that the stagflation concerns that were sort of downplayed by Jerome Powell was justified?
Absolutely. I mean, look at the data. I mean, we might add 240,000 jobs. I mean, we're going to see the data on Friday. Inflation is kind of stuck. It's still sticky around 3%. Needs to come down, but it's still there. So jobs are there, and overall wages are rising. So everything is pointing towards a steady state and doing pretty well. Nothing's deteriorating at this point. So stagflation, the stag in the stagflation is not happening. There is inflation, but there's no no stagnancy there. So things are developing. So that part of the equation is not working. So stagflation is out of picture. I know there was talk last week a lot, but it's not happening. When we saw the 1.6% GDP and inflation at 3, people thought, hey, think the economy is slowing down, inflation is still high, so we're heading to stagflation. But that's not the case. Let's see the GDP data for next month. Already expectations are 2.1% for next quarter. So I don't think economy is slowing down at this point. Stagflation is out of picture at this point.
Okay, Santosh, great to have you on the show. Thanks for joining in with that perspective.
Yep. Thank you. Thanks for having me.
Well, lots for our markets as
If you like this video, then like, share and subscribe to ET Now.